Now, finally, this is probably one of my favorite charts of all time now, because it really does highlight why oil prices are going to go through the roof. Because everyone knows that it doesn't matter what markets, it comes down to supply and demand. If the supply is low, demand is high, you get a high price for a product or commodity. And you can see here, this is the rig count in the United States of America. So it literally counts every single rig drilling at this moment in time. So generally speaking, we have 2 rigs out of this number. So we've got one that's going to start drilling at Seminole County, which is going to be the lowest one well, weather permitting, very, very soon. And we've got another well that we're just about to start drilling at our Mesa Vista ranch. So out of this number, which is 359, there's actually 2 rigs that are going to be ours on this number. So very interesting. If you look where we were for, a good couple of years here, 2018 to 2019, you're probably ranging from sort of 685, anything up to around about 850, 860. So you can see there has been a reduction in the amount of rigs drilling, and that comes down to a lot of the big oil and gas companies, BP, Exxon, the big public listed companies, energy companies. They're going into renewable and green, so they're not putting as much money into drilling for new oil and gas projects. They're putting their money into different areas of energy. So you can see very clearly that's having an impact on the number of rigs drilling actively in the United States of America. Now, as we know, March last year, that was when everyone was at panic stations, COVID-19, and really the bottom fell out the oil market. WTI got smashed, was minus for a day. And of course, people weren't drilling for oil. Most companies have break-evens per barrel of oil at $30. Seminole County project is that special. It's about a $12 to $13 break-even on a barrel of oil. So that's why it's a very attractive investment. But going back onto these charts, you can see that we've gone from, call it 660 down to at one point as low as around about 180. And now you can see there's been a fairly steady increase, but where we are today with 359 compared to we were pre-COVID-19, it's probably just over 50% of the rigs that were drilling for oil around about 1 year ago, or a year and a few months with some change. So you can see here with a natural decline in wells producing oil, around about 30–40% in the first 2 years, with the half the amount of rigs drilling for oil, and the well getting back to normal. America and England are the top 2 countries for having the vaccines. America is getting back to normality now, and the demand for oil and gas, jet fuels, all of these commodities, oil and gas products are actually, demand is increasing significantly. So I thought that was really important to understand, is that there are literally half the amount of rigs drilling for oil. And because of the transition between oil and gas companies going into renewables, it gives Alpha 7 Energy a huge opportunity, because we're a small company, we have low operating costs, we are able to make a small project highly profitable because of that fact, and we are going to be able to fill the gap between the supply and demand factor, and of course the transition into where we are today, into greener renewable energy. And for the next 2–3 decades, we believe there is a massive opportunity to make huge profits within the oil industry. Also gas as well. Gas is looking at increasing by a couple of dollars over the next 5 to 6 years, but predominantly oil is where we see major profits being made for our investor partners in our project. So thank you for your time. Grant McLaughlin from Alpha 7 Energy, signing out.